Very good morning. Dear students, now we will discuss definitions of tax avoidance and tax evasion and management. First, we will discuss tax avoidance. Tax avoidance is an act of using legal methods to minimize tax liabilities. It is an act of using tax regime in a single territory for one personal benefit to decrease one tax burden. It means if you are paying to tax your income, definitely you will be as per law. You can use the loopholes of the law and you can minimize your tax burdens. Tax avoidance is a legal matter. If you are using tax avoidance, it is a legal matter. Tax avoidance is an activity of taking unfair advantage of a shortcomings in the tax rules by finding new way to avoid the payment of tax that are within the limits of the law. Tax avoidance can be done by adjusting the accounts in such a manner that there will be no violations of tax rules. Tax avoidance is lawful, but in some case it could come in the category of crime. It means if you are not using properly law, definitely tax avoidance it will become on the category of crime. Now, I'm giving to a numerical example. To make a claim for deduction under the Income Tax Act 1961, Section 80C and Section 80CCD 1B, Clause 1B, and paying the tax of on initial amount is 10 crore rupees. They will now pay tax on 8 lakh rupees. This is imputation of tax evasion. And now we will discuss is tax evasions, and tax evasion refers to illegal act of deliberately avoiding pay taxes by uh, concluding income, understanding profits, overstating expenses, or engaging in other prudential activities to evade tax obligations. It is a criminal offense punishable by fines, penalties, and even imprisonment. Example of tax evasion includes under reporting income earned from freelance working to avoid paying as per Income Tax Act 1961 and classifying business expenses to reduce taxable profits and engages in cash transaction to evade sales tax. All example is tax evasion. For example, I'm giving to numerical example. Suppose a person is a self-employed individual earn 1 lakh rupees in income from freelance work, but only reports is 80,000 only. On their tax returns is 20,000 rupees to evade taxes. If the rate of tax applicable in their income brackets in 25%, the tax evaluated would be 5,000. Is it will be 5,000 is suppose 20,000 rupees, 25,000 rupees at the rate of 25%. This amount will be 5,000. It means you are tax evasions examples. Now we will discuss is the tax management. Uh, Tax management also it is the part of tax planning. We can say easily tax management involved in the tax planning. Uh, Legally minimizing tax liabilities in tax management, we are reducing the tax liabilities taxpayers. By follow through strategic planning, companies with the tax laws and taking advantage of available tax saving opportunities. In tax management, focus on optimizing tax efficiency while ensuring adherence to legal and ethical standards. Examples of tax management strategies includes contributing to retirement accounts such as 401k as or IRA to reduce taxable income. Maximizing deduction of mortgage interest, charitable donation, and medical expenses, and life insurance premium, how to manage the sections and education loans and etc. and home loans. This is the tax management parts and timing capital realization of tax advantage and lower tax rates. Suppose we are using the capital uh, gains and what is the benefits for as a taxpayers. For example, consider just I'm giving to a numerical examples. We are using the mathematical terms. Suppose a business that purchase a new equipment. Suppose you start a business and you purchase some equipment. Its cost is 50,000. Under tax management, the business can take advantage of the section 179 deduction, allowing them to deduct the full cost of equipment in the year of purchase. It means, suppose you purchase in 2023 and we can use in the 2023-24 in the financial year accounting year. It is Your difference is the accounting year and financial year. If the business is in 25% tax bracket, the deduction would be result of the saving in 12,500. It means 50,000 at the rate of 25%, it will be cost as 12,500. This is the example of numerical as a tax management. Now, I will discuss tax avoidance and tax evasion and tax management. I will be discuss a single platform. I've discussed in the individual what is the meaning of tax avoidance and what is the meaning of tax evasion and tax management. Now here I will be discuss in a single platform and what is definition of tax avoidance and tax evasion, tax management. My dear students, please listen carefully. And the legal act of reducing of tax of liabilities, this is the definition of tax avoidance. We are using of as per uh, as per law. And tax evasion is we are using unethical, it means illegal. And tax management, we are using strategic planning and compliance with the tax of rules and regulations. It means we are using here tax planning. And legality, tax avoidance and tax management is legal and tax evasion is illegal. Intentions, but within the parameters of the law and tax evasion is not is the required of breaching of the law, breathing of law and international within the law of maximize the tax burden in tax management and methods. Tax avoidance is the legal methods and classify information and under reporting income is tax evasion. For example, suppose your income is 1 lakh, but you are showing is 80,000 rupees. And tax management structure finances to lawful reduce of the tax. And now I will be come into conclusions of what is the tax avoidance and tax evasion and tax management. Uh, as you know, what is tax avoidance is a legal methods, and but we are using of the loopholes of the law and incentives in the tax system. So, Indian tax system, which provide for a taxpayers as per Income Tax Act. And tax evasion is the other hand for the illegal act of not properly illegally. Here is known as avoiding tax or fabricating informations and underreporting incomes. Suppose we are not providing for income tax department is the properly information. We are hiding some information. We are not showing the incomes. We are showing extra expenses. This is illegal methods, and this is the part of tax evasion. And if you catch giving the information, providing to wrong information, so it is not helpful for us. Then tax authority will be take action or as a punishment, as a penalty, and it may be jail. And tax management and then strategic planning part of for a taxpayers, how to investment for the use of investments policies and returns, and what is the tax burden minimization as per rules and regulation income tax authority. Tax avoidance and tax management are largely acceptable. Everybody acceptable tax avoidance and tax management, but tax evasion is not acceptable. So, understanding critical situations for the nations. If you are suppose you are doing for the country development, chartered accountant is a financial doctor in a country. It will be helpful for your economy, and if we will be pay properly tax, definitely we will be developed, and we will be hospital facility. We will be well educated. It will be helpful us our the society. Now I will be come to discuss basically why we are doing strategy the tax planning. What is the objective of tax planning? What is the main purpose? Now I will be detail discuss as per some heading points, and I will be discussing in details and how it will be helpful for us. Uh, Tax planning involves strategic decision making aimed at minimizing tax liabilities while ensuring compliance with the tax laws and rules and regulations. In the context of India and Uttar Pradesh and many states and union territories, where tax law are complex and constantly involve effective tax planning is essential for individual, and it may be business and their tax positions, enhance their financial outcomes when they earn the profits and they are paying to tax. We elaborate one each objective of the tax planning. What is the main objective for tax planning? Why we are providing tax planning facilities, and why prepare to tax planning? It will be helpful for our economy, and it will be helpful for a taxpayer person, and it will be helpful of the society. Now is first point is as a taxpayer in the circumstances. Number one is minimization of tax liabilities. In tax liabilities, in the primary objective of tax planning is to minimize tax liabilities by utilizing tax saving opportunities, deductions, exemptions, and credits available under the tax laws. By strategically structuring financial transactions and operations, taxpayers can legally reduce the amount of taxes owed to the government. For example, Indian companies may leverage incentives and concessions provided under the government schemes to minimize their tax liability. Just I'm giving you example of a numerical. It will be helpful for understanding the minimization of the tax liabilities. Suppose a manufacturing company, his name is Pital Nagri, any export company. So India with taxable income of is 1 crore rupees. If the applicable corporate tax rate is 30%, it means if you earn 1 crore rupees, any firm, and you are paying to corporate tax is 30%. How many amount will be 1 crore rupees? 30% is 30 lakh rupees. By claiming eligible deduction and incentive, the company reduce its its taxable income is 80 lakh rupees, resulting in a tax liabilities is 24 lakh rupees. Thereby saving is 6 lakh rupees in the tax. If you are properly paying to time to tax and calculations, if your exams, suppose your income is on 1 crore rupees, if you are having proper balance sheets and properly, it will be your income is 80 lakh rupees and you are paying to tax is 24 lakh rupees and there is the same 6 lakh rupees tax. If you are planning property tax planning, definitely you will be reduce tax payment. It will be helpful. Now I will discuss two second point is cash flow management and cash flow management also focus. Managing cash flow management as per we have already studied in the BComs is the accounting in the 12th class, the CBSE boards. Accounting is standard 3, cash flow management. How it will be managed as per we are all rules and regulations as per accounting standards, the cash flow management. But we are here to discuss is the tax planning management. It will be helpful for a any organizations and for a person. Tax planning also focus on managing cash flow by optimizing the timing of income reconciliations and expenses deduction to match cash flow inflow and outflow. It means how many income and how many expenses you are showing. It will be so in your cash flow management by strategically planning in the timing of taxable event. Taxpayers can improve cash flow and the liquidity. It means suppose bills receivables and bills payables and debtors and creditors. Suppose you have not properly and all accounting documents, definitely you can go in the loss and you cannot manage the properly your profits. Indian companies may be differ from income reconciliations, accreditation, deduction, expenses to optimize cash flow and working capital management. It is the cash flow management. It will be successful when you working capital management in your organization. Suppose I am giving two example a numericals, just giving two examples. Suppose a construction company or it may be a manufacturing company has the option to defer recognizing revenue from a completed project until the next financial year. By deferring revenue recognitions, company can delay paying taxes on the income earned, thereby preserving cash flow for operational needs or investment opportunities. It means if you are properly cash flow management, then definitely you will be rules and regulations follow. A company delay pay the tax on the income earned and thereby preserving cash flow of person needs to investment opportunities. If you have more than funds for working capital management, definitely you have the opportunity for investment your funds, and definitely you will be cash flow management in the working capital management. Now, third point is risk management. Risk management, you can say how it will be helpful for the risk management. If you will be properly tax planning management, definitely you will be properly reduce the risk in your organization. Suppose a tax planning involve tax-related risk by ensuring compliance with the tax laws and regulating and minimizing the risk of audits, penalties, fines, and legal disputes by maintaining accurate reports. If you will be have properly records, time to time audits and records, and if you have any penalty, you pay to timely, and your legal disputes, if you have any legal disputes, any authorities, you can discuss time to time. You can reduce the risk if you will be follow the tax planning, tax planning, or maybe tax management by maintaining records and any reporting requirements and implementing robust internal control. If you will be time to time internal audits, and taxpayers can reduce exposure tax related risk. You can risk reduce if we will be taxpayers. For example, if suppose some person is investing your company, it will be beneficial for your investors. You will be reduce the risk. Suppose you will be properly managed, the investor can benefit your company, and definitely your company prices, share prices will be increased. For example, just this technically, technologically, company in India conduct regular tax audit and complaints reviews to identify and address potential areas of tax risk, such such as transfer pricing issues or ambitious tax positions. By providing and managing tax risk, the company avoid costly penalties and legal disputes with tax authorities. If you have any disputes, any authorities, and you can properly can to manage if you have properly maintained the documents, you have properly reports the if you have properly reports the documentations. Now is second fourth point is optimizing investment returns. In tax planning, very important points for as a investments returns. Suppose in your company you are doing investments in another company, and some person doing your investment in your company. It is a point for very important points for the tax point of view, tax planning point of view. And if you have profits, you will be paid tax. If you will be investments, this amount will be time to time. Definitely, you cannot pay the tax, and your amount will be reduced for the tax amount. For example, so optimize investment returns by minimizing the impact of taxes on investment gains and incomes. Strategically, as per tax planning, selecting tax efficient investments, vehicles, structures, taxpayers can maximize after tax returns on their investments. Indian investors may consider investing in tax saving instruments like ELSS or tax free bonds and hence investment returns. All theoretical points, just I am giving to a numerical examples. Uh, I will be try to my best for help your understanding optimization of investment returns. Suppose a individual investors in India invest is 1 lakh rupees in ELSS mutual funds scheme, which offers tax benefits under Section 80C as per the Income Tax Act 1961. If the investment generate return is 12% annually, those is related to minimum on average 12% returns annually. All mutual funds, if you, a fund manager have properly managed, definitely mutual funds giving to returns is 12% annually. The investor can save is 30,000 in taxes, assuming 30% tax rate, while earning tax-free returns on the investment. Definitely, you can get up 30,000 rupees on the tax is suppose 12% is returns. And very important points. The last point is estates planning and wealth preservation. Tax planning is encompasses estate planning strategies aimed at minimizing estate taxes and preserving wealth for future generations. If you are wealth future generated, definitely your economy will be improved. Definitely now is nowadays is your Indian economy is fifth position, and if you are will be improve your wealth, definitely your economy will be in coming year. It will be definitely top third and top fourth position. By structuring estate plans effectively, taxpayers can transfer assets to hear beneficiaries in a tax efficient manner, thereby minimizing estate tax and maximizing the value of estates. Indian families may utilize tools such as trust, wills, and suggestion plan to facilitate estates and planning objectives. For example, a wealthy family, suppose here is the meaning of wealthy. So, suppose in a family it's 5 to 7%, and 5 out of 5 to 7%, 3% is earned. All income is properly. It means this family is healthy. This is a wealth. Family in India established a trust, hold assets, and distributes wealth to future generations by transferring assets to the trust. The family can minimize estate tax and ensure their wealth is preserved and distributed according to their wishes, thereby creating a lasting legacy uh, for future generations. Everybody is doing for future savings. Suppose now is before conclusions, I have some more points. It will be helpful for tax planning objectives. One point is reproduction of tax liabilities, and if you will be paid. And now is very taxpayer is increasing year to increasing. It will be helpful our economy and productive investments. If our organizations, our person is investing in different. I am working is in teaching line is 19 years, and when I start the career in insurance company, then I see mutual fund very small market capture and insurance is high. But nowadays is mutual fund is very high market shares and insurance is now will reach again to reinsurance position. And but here is very necessary for the work here. It will be helpful investments policies. It will government will be see futures what is the benefits for our citizens, senior citizens, and women entrepreneurs, etc. And the healthy growth of the economy. If our tax planning is very strong positions, it will be help for our economy, and it will be increase for economy and economic stability. If many taxpayers, it will be increase year to increase. Definitely, our economy it will be stable for the futures. And if our economy will be stable, so definitely we can complete achieve the target in 2047. India will be developing country. It may be if, every citizen work on the seriously on and the honestly definitely will achieve that target before that time. Now I will be discussing the conclusions, the objective of tax planning. Tax planning in India's and states has various objectives, including minimizing tax liabilities, managing cash flow, and tax-related risk, optimizing investment returns, and estates planning, wealth preservation, and reproduction of tax liabilities, and productive investment, and health growth of economy of stability. All points is very important for in the conclusions. By strategically planning and managing their tax affairs, individuals and business can achieve their financial goals while complying with the tax laws and regulations. Effective tax planning requires a true understanding of tax laws as per Income Tax Act, Custom Act, and Sales Tax. Carefully analysis of financial situations is a person and is a organization. A person I will be next is block two, and unit one I will be discuss what is the person and how will we pay the tax. Calculation of tax of income of calculations and proactive implementation of tax saving strategies tailored to specific needs and objective of taxpayers. Governments is the working is how to increase the taxpayers. Both it will be how to structures of calculation of the income working. I see many changes in the income tax returns and the tax benefits, and I will be discuss in below seconds. All the tax structures and new tax structures, what is the beneficial structure for the taxpayers. Some places is very beneficial for this, as how to calculate of individual income, HUF income, and any organization.